Malaysia's economic prospects, a pivotal shift on the horizon. According to a recent analysis conducted by BMI, a subsidiary of Fitch Solutions, it appears that Malaysia's economic trajectory is set to encounter a significant slowdown during the latter half of 2025. This outlook arises even as the nation demonstrated a resilient real GDP growth rate of 4.4% year-on-year in the second quarter of 2025. But here's where it gets controversial. Despite promising signs in private consumption, expected to remain a crucial pillar for economic momentum, a downturn in export activities combined with declining fixed investment is poised to impede overall economic progress. BMI continues to predict a full-year growth rate of 4.2% for 2025, positioning it at the lower end of the government's recently adjusted forecast range of 4.0% to 4.8%. Key elements impairing economic growth. Several underlying factors are driving this expected slowdown. 1. Deceleration of exports. After an encouraging start to 2025, exports are predicted to decline as businesses finish up front-loading activities, the practice of hastily importing or exporting goods ahead of anticipated changes in regulations. This halting of export momentum is a vital aspect to consider. 2. Reciprocal tariffs. The report draws attention to a newly introduced reciprocal tariff of 19% on Malaysian exports bound for the United States, a substantial increase from earlier expectations. This tariff will likely hinder Malaysia's export growth, serving as a formidable barrier in international trade. 3. Diminishing investment. Additionally, the anticipated growth in fixed investment is expected to be negatively affected, especially within sectors like data center capital expenditures. Here, uncertainty surrounding policymaking could stifle investment momentum. The bright side, domestic consumption is thriving. In spite of the external challenges, the report sheds light on vigorous domestic consumption as a fundamental force lifting the economy. A tightly knit labor market, combined with an impressively low unemployment rate of 3.0%, is projected to sustain robust private consumption. Looking toward the future, a newly introduced public service compensation framework, anticipated to roll out in January 2026, is expected to further bolster domestic spending. This scheme offers a hopeful outlook for private consumption as we transition into 2026. Furthermore, the continuous decline in headline inflation, which hit 1.1% year-on-year by June 2025, complements the prospects for consumer expenditure. As we look at Malaysia's economic landscape, it raises an intriguing question. How sustainable is this reliance on domestic consumption in the face of significant external factors? Are we witnessing a robust shift in economic strategy, or are we merely postponing the inevitable impacts of decreased exports and increased tariffs? What do you think? Can Malaysia weather the storm, or are we on the brink of a deeper slowdown? Share your thoughts in the comments below.